There are a few tenets which I try and live my life by, and one of them is when I'm faced with a tough decision to make, I ask myself, if I was on my deathbed and I look back on my life, will I be happy I did it? Now, I don't think that I'm gonna look back on my deathbed and think to myself, geez, I'm so glad I lived a risk-free, sheltered life. I think that most of the things that stand out, most of those cherished memories that I have are gonna come from the times where I took a risk and it paid off. And now don't get me wrong, I'm not talking about reckless risk like Evel Knievel type stuff, although he did make quite a name for himself by doing that stuff. I'm more referring to risks where there is a sensible risk-return trade-off. So that is where the potential gain outweighs the potential loss. So for instance, maybe you overcome your fear of rejection and strike up a conversation with that person at the bar and you end up marrying that person. Or maybe you see your dream job application and you know you're underqualified for it, but you go for it anyway because you basically try to fake it till you make it. And that turns out to be a very rewarding, lucrative career for you. But my point is, life is about taking risks, measured risks, and it's no different with your finances. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are talking about risks. Without taking measured risks with your money, you are going to have to work harder than the person that invests their money. The reason being is the person that invests their money is gonna have their capital working for them and doing some of the heavy lifting when it comes to building in their asset position. And to explain this concept further, we can look at the index chart that Vanguard puts out every single year. This chart shows the return on your money if you had invested $10,000 back in 1992 with no additional contributions but all income reinvested. It breaks down the return into different asset classes, including US shares, Australian shares, international shares, Australian listed property, Australian bonds, cash, and it even shows CPI, which is obviously a measure of inflation. And this chart paints a very powerful picture because it outlines how the different asset classes have performed over time. For instance, if we look at the defensive style assets, which include cash and bonds, they have provided a steady return with very little short-term risk to capital, with the exception of bonds over the last 12 months due to rising interest rates. On the other end of the spectrum, look at shares and property. Over time, they have been on a roller coaster of a ride with particularly big shocks around the dot-com bubble in 2000, the global financial crisis in 2008, the COVID crash in 2020, and even now in 2022/23 with the heated inflation and rising rates. But let's for a minute focus on the long-term outcomes rather than those short-term fluctuations. On the very conservative side, we have cash. If you put $10,000 into cash in 1992, today you would have $35,758. This gives you an annualized return of 4.3% per annum. However, if you put the same $10,000 into US shares, today it would be worth $182,376. That's an annualized return of 10.2%. So knowing this, you tell me, what's more risky for a long-term investor, cash or shares? Most uneducated people and people that don't understand money and investing will say shares. But for me, I believe that cash is more risky over the long term. The risk of cash is that you're not going to generate a meaningful return over the medium to long term. At the moment, you're not even generating a positive real return because inflation is so high. And so what that basically means is that your capital is not working for you, so you have to do all the hard work by getting your earned income, which is a really difficult way to grow your net asset position. I personally believe that a better option is to work hard to earn some money, put some of that money aside, and use that capital in order to build wealth for you. That is what investing is. Now, there are a few very important points that we need to make here. First of all, investing is very risky if you have a short time frame, and generally your time frame should be greater than 7 years. Have a look at the GFC we talked about earlier. Between the period of October 2007 and March 2009, you would have lost, on paper, about half of your money. Now that would have hurt. That is why before investing any money, you need to understand what your investment time frame is. And now as an advisor, I have clients that are both retired and I have accumulator clients. And and their portfolios look very different because their time frames are very different. Secondly, the figures that we're looking at here are based on index investing. And for a lot of novice investors and a lot of people who are starting out on the investment journey, I think that index investing is a great way to go. But if you're gonna go out there and you're gonna try and be a stock picker and you're gonna try and find that next small company that turns into the next big tech stock or something like that, well then that's a lot more like gambling than it is investing, and so therefore your investment time frame doesn't really matter. It's going to be risky over the short, medium and long term. For me, I believe that investing involves putting together a portfolio of diversified high quality assets. Now for smaller portfolios, like I mentioned earlier, I do index only type investing. For larger portfolios, I opt for a more core satellite type approach. And thirdly, just because we said that cash is not a good investment option doesn't mean that you shouldn't hold any cash. Cash gives you a lot of financial security and a lot of opportunities in life, and so therefore everyone should have at least an emergency fund. What we're talking about here is we're talking about investing the excess capital that you have above your emergency fund. And under my system, this really falls under phase 2 of the wealth creation process. To wrap this one up, I just wanted to share a quick quote by John A. Shedd, and he said that a ship in the harbor is safe, but that is not what ships are made for. And now in this instance, cash is the harbor, it's safe there, but if you want your money to work for you, you need to invest it. But that's it for me today, guys. Thanks a lot for watching. If you like this video, please give it a thumbs up and I will see you guys in the next one.